Imagine waking up tomorrow and discovering that $1 trillion appeared in the financial system overnight. No trucks delivered it, no printing presses ran through the night, no vaults were opened. It simply appeared. Not in cash, not in coins, but as numbers. And the strange part is, this has already happened, more than once. In 2008, during the global financial crisis, central banks created trillions of dollars in new money. Then again in 2020, when the world economy suddenly slammed on the brakes. But almost none of that money was physically printed. Instead, it was created digitally, quietly, inside the banking system. Which raises a strange question. If money can appear with a few keystrokes, what exactly is money? To understand that, we need to step back for a moment and look at how most people imagine money creation. The popular image is simple. A government needs money, so it turns on the printing press. New bills roll out. Problem solved. It's a dramatic image. Stacks of fresh banknotes flying off giant machines. But in reality, physical cash is a tiny part of the total money in the economy. In most developed economies today, over 90% of money exists only as digital entries inside bank accounts. No paper, no metal, just numbers in databases. So when central banks create money today, they usually aren't printing anything. They're changing those numbers. But before we get to that part, we need to understand who central banks actually interact with. Because central banks don't deal directly with most people. You and I have accounts at commercial banks, but commercial banks have accounts at the central bank. You can think of the central bank as the bank for banks. Inside that system, every major bank holds reserves, a kind of digital balance stored at the central bank. Those reserves are the plumbing of the financial system. They're what banks use to settle payments with each other, manage liquidity, and keep the system running smoothly. Now imagine the economy is in trouble. Businesses are failing, credit markets are freezing, banks are getting nervous. If banks stop lending, the economy slows down fast. So the central bank steps in, but instead of handing out trucks of cash, it does something much simpler. It creates reserves. Here's how that works. Suppose the central bank decides to buy government bonds from a large bank. A government bond is basically an IOU issued by the government. Investors buy them because they're considered relatively safe. So the central bank goes to the commercial bank and says, "We'll buy $10 billion of those bonds." The bank agrees. The central bank takes the bonds, and in exchange, it credits the bank's reserve account with $10 billion. Where did that $10 billion come from? Nowhere. The central bank simply created it. A few keystrokes inside its balance sheet. On one side, it adds the bonds it purchased. On the other side, it adds newly created reserves. The balance sheet expands. Money has just been created. No printing press required. Now the bank suddenly has more reserves sitting at the central bank. Those reserves make the banking system more liquid. And that matters because banks use those reserves as the foundation for lending. More reserves mean more loans flowing into businesses, mortgages, investments, and spending. And slowly, that newly created money spreads through the economy, like water entering a complex network of pipes. You might hear this process called quantitative easing, or QE. During the 2008 financial crisis, the U.S. Federal Reserve created roughly $3.5 trillion through programs like this. Then in 2020, during the pandemic shock, that number exploded. In a matter of months, the U.S. Federal Reserve expanded its balance sheet by over $4 trillion. Again,
Most of that money never existed as physical cash. It existed as digital reserves inside the banking system, which leads to an uncomfortable realization. The amount of money in the economy isn't fixed. It can grow dramatically when central banks decide the system needs support. But here's the twist. Central banks can create reserves, they can inject liquidity, but they cannot directly control how banks or markets behave afterwards. Banks might lend aggressively, or they might sit on those reserves if they feel uncertain. Investors might fund businesses, or they might chase asset prices, stocks, housing, and speculative investments. That's why after the 2008 crisis, critics argued that much of the new money flowed into financial markets instead of the real economy. Stock prices surged, asset prices climbed, wealth gaps widened. The system stabilized, but it also changed, because when trillions of dollars enter the system, the effects ripple outwards in complicated ways. Interest rates fell, borrowing becomes cheaper, investments that once seemed risky suddenly look attractive. The entire financial landscape shifts. And that brings us to the deeper question. If money can be created digitally, why doesn't it immediately destroy the value of the currency? Why doesn't everything instantly become worthless? The answer is subtle. Money has value, not just because it exists, but because people trust the system behind it. Trust that governments will manage supply responsibly. Trust that central banks will control inflation. Trust that the economy will continue producing real goods and services. As long as that trust holds, digital money behaves like real money. But if that trust ever breaks, history shows things can unravel very quickly. Countries like Zimbabwe and Venezuela printed enormous amounts of money to cover government spending. Eventually, their currencies collapsed under runaway inflation. People stopped trusting the value of the money itself. But major central banks insist their system is different. They aren't simply printing money to spend. They're managing liquidity, stabilizing markets, supporting credit. At least that's the official story. Still, something interesting has changed in the past 2 decades. Central banks have become incredibly powerful. In moments of crisis, they can create trillions of dollars within weeks. They can reshape interest rates, bond markets, and financial conditions around the world. And most people barely notice it happening. No loud machines, no stacks of fresh banknotes, just quiet adjustments to balance sheets, digits appearing in accounts deep inside the financial system. Which leaves us with a strange reality. Modern money is no longer something you can easily hold in your hands. It's a system of trust, ledgers, balance sheets, digital promises between institutions. And sometimes, when the economy needs help, those promises can expand by trillions almost overnight. No printing press, no trucks of cash, just a few keystrokes, and the entire financial system shifts slightly beneath our feet. The real question isn't whether central banks can create money. We already know they can. The real question is this: how much money can be created before the system that gives it value starts to change?